Think Walmart in 1980, Apple in 2004, and Nvidia in 2016. What do they all have in common? All three stocks formed the same chart pattern before climbing to new heights in the market. It's called a cup with handle base, and by learning to spot this pattern when it's forming, you could be prepared to get in early on the next batch of major movers. The cup with handle base is called just that because its chart action looks like a teacup. But to be a proper base, it also has to fit a few criteria. The stock should run up at least 30% before forming this particular base, and then it should start selling off. That decline could be anywhere from 15% to 30% from the stock's high. Eventually, the stock finds a bottom or floor of support before climbing again. That happens when fund managers or other institutional investors stop selling their shares and shift back into buying mode, picking up shares and sending the stock higher. From there, a handle starts to form. A proper handle starts forming in the upper half of the base and is at least 5 trading days long, typically in light volume. So why is all of this selling off important? Well, it means that less committed shareholders are being shaken out of the stock, investors who maybe bought at the end of the prior uptrend and are now just happy to cut their losses and break even. Once those less committed investors are out, the stock has room to run. The shares encounter resistance as they form a handle, and this testing ground is where we'll be able to calculate a new buy point. Assuming the stock keeps climbing higher, that buy point is 10 cents above the high point of the handle. The buy range extends 5% above the original buy point, but it's best to get in as close as possible to the entry price. All told, a cup with handle should be at least 7 weeks long for it to count. Occasionally, you'll see them for in as short as 6 weeks. Let's look at a real-life example of a cup with handle base. Between January and March of 2016, leading graphics chip maker Nvidia formed a cup with handle base. Here's the prior uptrend, and here's where Nvidia pulled back to form the base. It found a bottom in early 2016, then worked on the right side of the pattern. Here's the handle. As you want to see, volume was light, meaning large investors weren't selling aggressively. Plus, its relative strength line was at a 52-week high as the stock started to take off. That's a bullish sign of market leadership, exactly what you want to see on a breakout. On the daily chart, you can see how Nvidia shares cleared a 33.16 entry point in heavy volume. After that breakout, Nvidia surged over 600% in just 2 years, forming additional bases along the way and offering entry points for new investors. Of course, not every stock will behave like Nvidia, but recognizing these chart patterns is crucial to learning when certain stocks may be on the cusp of making a major upward move.